Costco and Walmart are two of the best retailers in the world, but which one is the better investment at current prices? That's the question I'm going to answer in this video by comparing these two excellent merchandisers across various categories, including revenue, profits and cash flow, returns on invested capital, and then one metric that's very specifically important for retailers like Costco and Walmart, which is the inventory turnover ratio. And then finally, I'll compare them on valuation and determine which one I would rather buy at these prices. So let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So looking at the revenue over the last decade, they've both demonstrated solid growth. And Walmart, of course, is the larger company and the largest company in the world when measured by trailing 12-month revenue, just slightly ahead of Amazon. I wouldn't be surprised if Amazon surpasses Walmart any moment now. $673 billion in trailing 12-month revenue, compared to $258 billion in trailing 12-month revenue for Costco. Now, Costco and Walmart have done an excellent job utilizing and taking advantage of their scale to improve their relationships with suppliers. Or how should I say this? Optimize their relationships with suppliers and extract key negotiating benefits from their suppliers as a result of their scale, because suppliers really want access to all of those buyers that go into Costco and Walmart. And so they're willing to offer concessions to Costco and Walmart so that they can get access to all those buyers. Getting access and getting a position in Costco and Walmart could be a huge success factor for these suppliers. So they would be willing to give their products to Costco and Walmart at lower prices. They would be willing to give their products to Costco and Walmart on better credit terms, right? Instead of giving them 30 days to repay, they might be willing to give Costco and Walmart 60 days to repay. And the quickness of how they sell their inventory, which we'll look at a little bit later, if Costco and Walmart can get 60 days to pay back, a lot of times that cash conversion cycle, they'll sell that product before they even have to pay the supplier for the product. And so they get to turn over that inventory, and it becomes sort of like an asset-light business in that regard because of those terms that they can secure from suppliers. Not every brick and mortar business can benefit from that. Costco and Walmart are one of the few that do have that strong enough negotiating power where they've been able to secure those kinds of concessions from suppliers, which is critically important for merchandisers like Costco and Walmart, because inventory management is a critical factor in success in this category. The next metric I wanted to compare them on is operating profit margin. There's a couple of interesting things to note here with that. Firstly, Walmart's operating margin has been in decline for the last decade. The primary reason for that is Walmart shifting into lower margin businesses like grocery. Secondly, Walmart investing in its e-commerce capabilities, which it only recently started to do in the last decade, perhaps even more so in the last 7 or 6 years, where it really accelerated. No, in the last decade, they really accelerated those investments in e-commerce to they don't want to be as good as Amazon in e-commerce, but they want to have a strong option in that category. And they have done that. They've achieved great success in their e-commerce business, and that's now mostly behind them. And now they're benefiting from some of those investments, and that's why you see this uptick here in their operating margin. One of the benefits they're capturing from their online business is advertising. They're able to generate ad revenue on their websites now, more so than before. And that's a very high margin business. Look at their business overall is just a 4% margin. Advertising companies, it's not surprising to see advertising companies generating margins in the 30, 40, 50% range, operating profit margins. So that segment alone can lift their margins. Costco, meanwhile, has a different strategy. Their margins have been steadily rising, very, very small though, right? You can see that 3.7% operating margin. It's barely up from like 3% 10 years ago, but it's been rising higher. Costco's strategic in that they don't want to increase their margins by too much. They want to, whenever they benefit from economies in scale, they want to pass those benefits on to the buyers, onto their customers. And they'd rather have that strong customer loyalty and give customers that great value and keep their margins low. One of the things with having smaller margins is that you repel competitors. No one's going to fight with you in a business that has a 3% operating margin, right? You're not going to have competitors saying, hey, let's spend $100 billion trying to compete with Costco and Walmart in this industry that has a 3 or 4% operating margin. And so that's one of the things that, it repels competitors. It's also one of the hardest competitive advantages to maintain. It takes a lot of skill, it takes a lot of execution to be able to maintain a business with this strategy, the low-cost business model. Very difficult to do, but if you are able to achieve it, the competitive advantage is one of the most sustainable competitive advantages you can have in business because of the factors I highlighted earlier. Low margin repels competitors. That high barrier to entry is going to repel the competitors. And then the skill that it takes, the learning curve of decades operating this kind of business model puts you leaps and bounds ahead of competition. So those are some of the forces to consider here with Costco and Walmart. Returns on invested capital. This is an important metric. Costco at 25.4% is doing much better than Walmart, and it's been increasing over the last decade, really spreading and widening that gap. Walmart also solid at 14.83%. And it's important to compare the return on invested capital with the weighted average cost of capital. So let's look at that also. Walmart's weighted average cost of capital is just 7.5%. So with a return on invested capital of 15, it's roughly 2-to-1 ratio, which is a solid ratio and one of the better ones for retailers to be sure. And then Costco's weighted average cost of capital is 9%, and their return on invested capital was 25. So closer to 3-to-1 or 2.5-to-1 ratio, better than Walmart on the ROIC to WACC ratio, which is something I place highly on my analysis. And then finally, the inventory turnover ratio. This measures how quickly a company turns over inventory. And it's a way of measuring how long items are sitting on the shelf. For a merchandiser, which is what Costco and Walmart is, they are merchandisers. This demonstrates how good they are at managing the business, how good they are at finding products that their customers want to buy, when their customers want to buy it, at the locations that customers want to buy it at, and at the prices that customers want to buy. This is critically important. Costco has an industry-leading inventory turnover ratio, best in class. Walmart comes close at 11.5, but Costco beats them out at 14 compared to 11.5. These two are two of the best in the industry in this regard. You would expect them to do strongly in this metric because they have the low-cost strategy. When you have a low-cost strategy, you want to look on the flip side, which is a high inventory turnover. If the business you're looking at has a low-cost strategy, but it trails behind the competitor that is not employing the low-cost strategy, it's a signal that their business model, they're not good at executing their business model because they're not winning in the category they should be winning on if they have the lower prices. And so Costco and Walmart are winning in these categories, especially Costco. So now that we've looked at the critically important financial metrics, we can look at valuation, which is where I get a bit of a shock when I look at the valuations because these two merchandisers, brick and mortar retailers, are trading more expensively than AI stocks right now. Costco, so expensive, a forward price to earnings of 53, the most expensive this stock has been going back a very long time. But I will remind you, I have been saying that about Costco for 5 years now, almost 5 years now. There's brief moments where I said that Costco stock was not overvalued, and the stock price has just kept booming up during that entire time. Walmart, meanwhile, there's been moments where I've said Walmart is undervalued. It hasn't been as expensive for as long of a time as Costco has been. Still, Walmart's trading at a forward price to earnings of 33. Again, more expensive than some AI stocks, right? Um, so expensive valuations when measuring by the forward PE. When looking at the discounted cash flow models, Walmart looks more fairly valued, slightly undervalued. The intrinsic value I have is 122. The market price is 104. Costco, meanwhile, the intrinsic value I have is 690, and the current market price is $1,062. So these are both excellent businesses I would love to own. However, right now, I would say if I had to pick one of them, I would pick Walmart. I really like Costco's business, but I can't get over how expensive it is at a forward price to earnings of 53. Costco is one that I've just had on my list and have never had an opportunity to buy because I've always felt like it's too expensive. So if I had to pick today, I would pick Walmart out of these two. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.